This transport company makes 4,000 deliveries a day to leading retailers and cafes. The owner says when the price of petrol comes down, it's good news for everyone.
At one stage, fuel was costing us around the $2.40 mark, and now it's come down to $1.60. That's 80 cents a litre difference.
Which will benefit his customers.
When the fuel comes down, we pass it on, but things like rates, taxes, for us, they've gone up in the past year.
The price of Brent crude oil fell below $70 a barrel this month, its lowest level in almost 3 years, and now it's hovering around $73. That's pushed down the average petrol price at the pump to $1.78, and the average diesel price is now about $1.82.
They were going down, but I found they were really inconsistent. Like they would go up and then down and like every few days or so.
Absolutely has an impact. You think twice, when your dollar only goes so far, then you've got to pay your electricity bills, you've got to pay your food bills, your rental costs up here.
It's too expensive, considering we have the biggest oil and gas field just off the coast.
The oil price is under pressure because of lower demand from China.
What the International Energy Agency has forecast is that global oil demand this year will grow about 0.9%, and next year it'll do exactly that. Now, to put into perspective what China's oil demand growth is going to be this year, it's roughly around 1%. Now, last year it was 10%. So it has been a major downgrade coming through with China's oil consumption.
That's seeing countries that form part of the OPEC oil-producing nations cut supply and also lower forecasts for global oil demand. Analysts expect the price to fall as low as $65 a barrel in coming weeks, which would put downward pressure on what consumers pay at the bowser.
We're talking somewhere in the realm of $1.65 to $1.70. So immediately over the next couple of weeks, as we see oil prices filter through to domestic petrol prices, that's probably the price range in terms of the national average that we expect.
I think the factors at the moment are generally suggesting that oil prices will continue to stay where they are and stabilise. The Australian dollar looks to be fairly steady in the near term, so what we're expecting to see is an outlook that is probably looking towards slight downward pressures in the near term.
But there is a scenario where petrol prices could rise again. If tensions between Iran and Israel escalate and there's a regional war, that would hurt oil supply. The big uncertainty is what oil-producing nations in the Middle East decide to do.
Geopolitical tensions remain an ongoing risk for oil markets. There is a risk also that OPEC actually change strategy and despite the softness of prices actually decide to increase production because OPEC cutting back production at the moment really just leaves the door open for other countries to produce more, such as the United States. So there is a risk, certainly if OPEC did change strategy in that regard, that oil prices could go a lot lower, at least in the short run.
Economists say while falling prices are good for consumers, it won't lower underlying inflation as far as the Reserve Bank wants it to.
It's going to help with the margin, but not by enough, I don't think, to have the RBA bring forward rate cuts into this year rather than next year.
Back at the warehouse, John DeLosa is hoping those rate cuts come sooner.
It'd be a lot more helpful because people will have more money, and the more money they have, they can actually spend more on buying that extra steak or the extra biscuit or the extra cake.
Extra spending for an economy slowing down in speed.